Let's discuss some more earnings, and we have Rajiv Batra, CFO of Cummins India, joining us to analyze their numbers. Q4 was a mixed bag, Mr. Batra, with domestic business doing well while exports lagging. Was it in line with your budgeted estimates?
For the quarter, as we compare this to a year ago, domestic was negative 5%, though for the year it was a positive 1%. Exports actually grew 30% for the quarter, while for the year it was negative 2%. So, if you look at what guidance we had given, the guidance was domestic 0 to 5, so we are at the lower end of the guidance. Exports was negative 5 to negative 10. Actually, we were negative 2. So, again, we're in the band. So, this year we did not expect, given market conditions, the revenues to grow double digit. That granted, our industrial business, which is the segment that I would talk about, which actually returns to that performance. Construction came in with a 19% growth comparative to what we had last year, which is a 35% growth. Our rail segment increased 49% year on year. And last year also it had increased some 15%. Mining, again, a smaller success story, but still growing. So if you look at our industrial businesses, this has been about the third year where it has registered double-digit growth. So the industrial business is something where we are fairly satisfied with the performance, and we're looking at this as a growth engine going forward as well. Where I think we've hit some challenges are some execution challenges in the last quarter on our power gen side of the business. Clearly, we had some orders with us, and the secondary sales increased at a pace where we could not match the primary sales into the channel, and that's where we lost out some revenue. But be that as it may, we're still holding at about 1,000 crores for the year, which is where it was last year. So, some execution challenges, but I would say going into the future, we should see 8 to 9% growth on the power gen space.
Now you guided for 8 to 10% growth in domestic business, but flat for exports in FY19. There is already a favored base in this conservative or cautiously optimistic?
I think guidance is something which is taken and given at a point in time. So as the year goes through, we certainly will be looking at a guidance as we did last year. Exports, they're impacted by multiple challenges, and some we understand and some markets are impacted by forces which we don't understand. For example, last couple of years, oil has been really down, and that's, in fact, our demand from Africa and the Middle East is severely curtailed. Now we see that start to come back. So at this point in time, we're holding I would say, a pessimistic / realistic guidance on exports, which says we should be flat, but I can see that if this play continues, in some parts of our market, we would actually improve on the exports. Domestic, however, as we said, between an 8 to 10%, that is, I would say, a realistic guidance. And again, this would require double-digit growth from our industrial businesses, power gen growing at 9%, distribution growing at 9%. So all of our businesses have to grow between 8 to 10% to get here.
What pickup do you see in the export markets like Middle East and Africa, which are underpinned by firm oil prices, and they've also contributed only half of what they did earlier? So can those geographies come back now that oil prices have gone higher?
If we look back at the Middle East and Africa's, over the last 2 to 3 years, we've seen these numbers at about 50% of where they were. So, as the oil prices remain stable at or around this dollar pricing, I would expect some of this to translate into developmental spend, and that's something which I would assume should see us coming back on the Middle East part of the business, the Middle East of the Africas. So that's kind of where we are. Now, how much comes back and how much is the actual spend happening, that over the next few months we will start to see.
Right. You've gained 300 basis points market share in high horsepower segment in FY18 despite a flat market. Since this remains the focus, what gains do you envisage here over the next 2 to 3 years along with the mid HP segment?
We've been holding share for the most part in the mid-range with some very successful products. And on the high horsepower part of the market, which is really our focus, there we've been improving our market shares across nodes. Not very much, but the trend has been positive. Given the aggressive stance of competition and the market having been flat for the last 2 to 3 years, that is a significant achievement. So consequent to that, if the market were to open out and we see revival across certain sectors which positively impact high horsepower, then we could in the first instance look to be more aggressive than what we've been in the past.
Order book stack up and inflows you're penciling over the year?
The order book remains healthy, and like I said, this last quarter we had some execution challenges. So while we don't get very specific on various segments from which orders actually come from, but it appears at this point in time that both industrial and power gen, we should see some recovery as the year goes through.